In the last 14 days, diesel fuel prices didn't just rise. They spiked by over 36%. Not in a year, not over a slow trend. In days. And jet fuel? Up nearly 85%. At the same time, the average price of gas in the United States jumped from under $3 per gallon to roughly $3.70, almost overnight. Most people see that and think, okay, gas is more expensive again. That's the surface. What you're not seeing, what almost nobody is connecting, is that this isn't one problem. It's five separate waves, each hitting a different part of your life, each arriving on a different timeline, each more expensive than the last. And here's the uncomfortable part. Your brain is wired to ignore 4 of them. Hey, I'm Brian, and I spend way too much time thinking about how small economic shocks quietly turn into big financial problems. If you care about making better decisions while everyone else is reacting late, subscribe. Think of it as the highest return on investment you can get for your time, or just peer review for your financial thinking. Because in the next few minutes, I'm going to break down exactly what's coming. Not just the economics, but why your own instincts might be setting you up to miss it. Wave 1, the visible shock. This is the one everyone sees. Gas, energy, the immediate hit. When oil prices surge this fast, it doesn't stay contained. According to data from the U.S. Energy Information Administration, energy costs ripple through nearly every sector of the economy within weeks. But your brain doesn't process it that way. It uses something called anchoring bias. Here's what that means in plain English. Your mind grabs onto a number you're used to, say, $2.80 per gallon, and treats it like a reference point. So when prices jump to $3.70, your reaction isn't, "This changes everything." It's, "That's annoying, but I've seen worse." That's the trap. Because you're comparing to the past, not projecting into the future. And historically, when energy spikes happen this fast, they don't stabilize quietly. They cascade. In 2008, oil surged above $140 per barrel before collapsing the economy months later. In 2022, a similar spike helped push inflation to 40-year highs. Different triggers. Same pattern. Fast energy shocks don't stay isolated. They spread. But most people stop their analysis right here. They see higher gas prices, adjust their weekly budget slightly, and move on. Which means they're completely unprepared for what hits next. Wave 2, the second-order hit. The second wave doesn't show up at the pump. It shows up at the grocery store. Because the same diesel that just jumped 36%, that's what powers the trucks moving your food across the country. Refrigerated trucks, long-haul deliveries, distribution centers. According to the American Transportation Research Institute, fuel can account for up to 24% of total trucking costs. So when diesel spikes this hard, companies don't absorb it. They pass it through. But here's why most people miss it. Your brain uses something called mental accounting. You separate your money into categories. Gas is gas. Groceries are groceries. So when gas goes up, you expect your transportation budget to hurt, but you don't instinctively connect it to your food bill, even though they're directly linked. It's like watching one domino fall and assuming the rest of the line is somehow immune. And this is where the squeeze begins. Because now you're not just paying more to drive, you're paying more to eat. Produce, meat, dairy, especially anything that requires refrigeration, gets hit first. And the timing is deceptive. You won't see it all at once. Prices creep, subtly, quietly, which makes it easier to ignore and harder to prepare for. But this isn't the peak. This is still early. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. Wave 3, the delayed system shock. The third wave is the one almost nobody sees coming, because it hasn't happened yet. This is fertilizer. Here's the connection most people miss. Fossil fuels aren't just used to transport food. They're used to produce it. Up to 80% of fertilizer production costs come from natural gas and other energy inputs. And major producers, countries like Iran, Qatar, and Saudi Arabia, are directly tied into the same geopolitical tensions driving oil prices higher right now. So when energy prices spike, fertilizer becomes more expensive. When fertilizer becomes more expensive, farmers either pay more or use less. And when that happens, yields drop or costs rise. Which means by the time you get to late summer or fall, food prices spike again. Not gradually, sharply. The World Bank has warned in past energy shocks that agricultural input inflation can lag by 3 to 6 months. But when it hits, it compounds existing food inflation. So you get hit twice. Now here's why your brain doesn't prepare for this. It's called normalcy bias. You assume the future will look like the recent past. So if grocery prices feel manageable today, your brain quietly concludes they'll stay that way, even though the underlying system has already changed. It's like standing on a beach after the water pulls back, thinking everything is calm, not realizing that's exactly what happens before the wave hits. And by the time you feel it, it's too late to adjust easily. Wave 4, lifestyle compression. The fourth wave is where it starts to feel personal, not survival. Lifestyle. This is airfare, travel, services, the things you think of as optional until they're not. Jet fuel has surged nearly 85%, and airlines operate on thin margins. They don't absorb shocks like this, they pass them directly to you. We're already seeing early signals of fare increases across major carriers. But here's the deeper shift. This isn't just about vacations costing more. It's about your entire margin disappearing. Because now you're paying more for gas, more for groceries, and soon, more for food production. So when airfare rises, or restaurants increase prices, or services quietly adjust upward, something has to give. And that something is your discretionary spending. This is where a different psychological pattern kicks in, the availability heuristic. Your brain judges reality based on what's immediately visible. So if you're not actively booking flights or eating out every day, you underestimate how much these price increases matter. Until suddenly, they stack, and your lifestyle starts shrinking without you making a conscious decision to shrink it. That's the compression. Not one big cut, 100 small ones. And by the time most people feel it clearly, 4 waves have already passed through their finances. Wave 5. The financial system response. Now we get to the wave almost nobody connects, because it doesn't show up on a receipt. It shows up in policy, interest rates, borrowing costs, the decisions made by the Federal Reserve. Going into this year, markets were pricing in multiple rate cuts. The expectation was simple: inflation was cooling, so relief was coming. That expectation is now collapsing, because energy shocks don't reduce inflation. They reignite it. When oil, diesel, and fuel costs surge this fast, it feeds directly into headline inflation numbers, the exact data the Federal Reserve uses to decide whether to cut or hold rates. And institutions like Goldman Sachs and JP Morgan have already started revising expectations. Fewer cuts, later cuts, or in some cases, no cuts at all. Here's what that means for you. Mortgage rates stay higher. Car loans stay expensive. Credit card interest keeps compounding. Not because policymakers want that outcome, but because they're reacting to the same wave you just saw hit gas prices. And this is where everything connects. Higher living costs from waves 1 through 4, combined with higher borrowing costs from wave 5, create a squeeze most households aren't modeling yet. But your brain still might not react appropriately. Because of something called the amygdala threat response, your brain's ancient survival system. When it senses stress, it doesn't think long-term. It narrows focus to immediate problems. So you react to today's bills instead of adjusting for tomorrow's system. Short-term reaction, long-term exposure. That's how people get caught. And while all of this is happening in your day-to-day life, there's another layer reacting in real time. The markets. If you've checked your portfolio recently, you've probably felt it. The S&P 500 has dropped nearly 7% from its January peak. Volatility is spiking. The VIX, often called the market's fear gauge, surged to around 32. That's not normal fluctuation. That's stress. Even assets people run to for safety aren't behaving the way they expect. Gold, typically seen as a hedge during uncertainty, dropped over 10% in a single week during this volatility spike. That confuses people, because they expect markets to be logical. They're not. They're emotional, just at scale. And this is where one of the most dangerous psychological traps shows up: loss aversion. Research from Princeton by Daniel Kahneman showed that the pain of losing money is roughly twice as powerful as the pleasure of gaining it. In simple terms, losing $1,000 feels worse than gaining $1,000 feels good. So when your portfolio drops, your instinct isn't to think strategically. It's to stop the pain. Sell. Exit. Do something. But historically, that reaction is exactly what destroys long-term returns. During the 2008 financial crisis, investors who sold near the bottom locked in losses of 40 to 50%, while those who stayed invested recovered within a few years. In March 2020, markets dropped over 30% in weeks, then staged one of the fastest recoveries in history. And here's the part almost nobody internalizes. The best days in the market tend to happen very close to the worst days. Miss just the 10 best days over a 20-year period, and your total returns can be cut nearly in half. This is what's called the behavior gap, the difference between what investments return and what investors actually earn because of emotional decisions. So while markets are reacting to all 5 waves in real time, most people are unknowingly amplifying the damage by reacting at exactly the wrong moments. And there's a bigger risk forming underneath all of this. If high inflation from energy combines with slowing growth from reduced spending, you get something rare and dangerous: stagflation, high costs, low growth, limited policy tools. We saw it in the 1970s. And the early signals: persistent inflation pressures, elevated energy prices, delayed rate cuts, are starting to line up again. Not guaranteed, but close enough that ignoring it would be a mistake. So what do you actually do with all of this? Because awareness without action doesn't protect you. First, don't panic sell. I know your gut is screaming to reduce risk when markets drop. That's the amygdala again, immediate relief over long-term outcomes. But history is clear: markets recover. Sometimes faster than you expect. Sometimes when you least expect it. Second, pressure test your emergency fund. Not "I think I'm okay." Actually calculate it. 6 to 12 months of essential expenses, not lifestyle expenses. Because waves 2, 3, and 4 haven't fully landed yet. Third, audit your spending now, not reactively later. Go through your discretionary expenses, subscriptions, dining, travel, and decide what stays before prices force the decision for you. Because cutting early feels like control. Cutting late feels like loss. Fourth, keep investing consistently. Dollar cost averaging works because volatility works in your favor over time. When prices drop, your fixed contributions buy more. It feels wrong in the moment, but mathematically, it's exactly what long-term investors benefit from. Fifth, map your personal exposure to energy costs. Your commute, your delivery habits, your business inputs if you have one. Ask a simple question: where does fuel show up in my life? Because those are the areas that will get more expensive first and most aggressively. And finally, separate the feeling of fear from the decisions you make because of it. Fear is information, but fear-driven decisions? Those are usually expensive. The goal isn't to feel calm. It's to act clearly. If you're feeling uneasy right now, that makes sense. You're not overreacting. You're reacting to something real. But there's a difference between fear that informs you and fear that controls you. One sharpens your thinking, the other narrows it. And when you look back at past crises, 2008, 2020, even 2022, the people who came out ahead weren't the smartest or the highest earners. They were the ones who adjusted faster. Not perfectly, just earlier. Because time, not intelligence, is the real advantage in moments like this. So now I'm curious, what's the first move you're going to make after watching this? Not 10 steps from now. The first one. Drop it in the comments. And if you want to stay ahead of the next wave, because this story isn't over, subscribe.